Good morning, everyone. So today is actually uh, week number, I'm adjusting my screen right now. So it's week number 9 right now, and we're going to talk about capital markets. Now, before we go to the lecture or the lecture PowerPoint, I just wanted to give you an idea of the capital market, right? Because the book goes directly on capital market. And then I wanted to give you a bigger idea of how this company source money through the financial institutions or the marketplace, as we may say, with regard to funding. So when you think about it, let's break down the concepts, right, in some simple terms. Now, as you grow as an adult, you need food for sustenance to grow. So as the business also needs to grow, it needs sustenance through injection of funds or capital in order for it to create new businesses, expand, globalize, and whatnot, right? Now, capital market is actually like on this level. And then technically, if you go higher, it will be called financial markets. So this is financial markets, this is capital market. So why the distinction? Because in capital market, you actually have another type of market or a marketplace for funds called money market. So you have now money market and capital market, both combined. It's actually called a financial market. So these marketplaces are basically source of funding, as we say. Now, money market is an access to current funds, short-term funding needed in order for it to get to grow the business, right? So, what are examples of money market? Money market is basically, I would say TCD, so Tango Charlie Delta, time certificate of deposits. So either you would actually get funding from the bank through a TCD. So the bank would ask for companies to invest on money or to invest money on high yield account. Remember, you would see high yield savings account. In turn, the bank would actually give you those money that they have collected from consumer, and then it will be given to corporation on a short-term basis, less than 1 year or 6 months or 180 or 270 days. Now, it can be a certificate of deposit, I would say, or it will be a commercial paper, basically a quick loan from the bank, right? Uh, so T-bills is also another way wherein you would actually get money as a company for a short-term time, a short period of time for T-bills. So so when you think about it, where's the money market? The money market is basically it's not a physical market, it's a virtual market of dealers. So the dealers are authorized to actually transact with financial institutions, with company. So, and then when the dealers are part of a group, and then they are able to transact over the counter, as they say, OTC, over the counter. And then these are mostly done electronically. Now, when you think about it, that's the money market, short-term funding needed for companies in order for them to use it to fund a project or fund a new acquisition or an acquisition assets like maybe inventory, fixed asset acquisition, wherein you don't have the means right now. Now, there's another one wherein it's called a capital market. So the capital market is a bit of a bigger way of doing things. So capital market means that you need to go outside of of the financial institution, and sometimes you would need, in most cases, you would need to hire an underwriter. So but before I go there, let me just like mention to you the two ways of doing capital markets. Capital markets, either you as a company issue new debt through bonds. We talk about the bonds, the calculation. So that's one source, right? Debt financing. The other one we've been talking about is equity financing. So you issue stocks, and then that will be through When you issue the stock, then that will be the equity financing. I'll talk first about equity financing. If you do equity financing, it means you're going to issue stock. So remember companies doing IPOs? So initial public offering is an IPO. It means that you are a company that's private, and then you would want to go public, meaning that you want to issue shares of stock. And if you issue shares of stock, you need to make sure that the companies would actually want to invest on you, like investors would want to invest on you. Both institutional investors, like big banks, say Fidelity is actually a financial institution that will buy stocks for its client. You and me are retail investors. So, Chase Bank or JP Morgan, they would actually buy a Goldman Sachs as an institutional investor to buy for their clients, maybe a government pension fund or anybody that they represent, right? But for you and I, uh, if we actually do a investment using Robinhood, like the app, so that would actually be us doing a retail investor. So we buy direct right through a market. Now, going back, if I'm a new company that's private, I want to take my business public, meaning that public, I'm going to be sourcing public funds rather than private equity investors because sometimes the market is bigger. What will happen now is that they would actually, I would ask an underwriter to help me. So an underwriter would actually be somebody that would help me with the regulatory process on how to list, meaning listing it in public, right? So the underwriter is mostly a financial institution. We've seen Barclays, we've seen Goldman Sachs to help you go to the market, right? And then or to go public. So they would help you with talking to the banks, talking to big institutional investors, and then to basically help you go through the process. They would also help you set the price of the investment. Why? Or your stock. Why? Because once you put your stock there, you want to make sure it's not too high valuation wise. It's not too high that nobody wants to buy it, and it's not too low that you would not get money that you need for investment. So what happened also is that um, that underwriter who would help you with the compliance, who would help you with the pricing, is the one also doing the issuance of that stock, right? That you're going to be issuing for your company. So if you're going to go through an IPO. So in the normal process, there will be the CFO of the company, the Chief Financial Officer, and the CEO of the company, the Chief Executive Officer, will go on what they call a roadshow. So a roadshow would be you you as a CFO, for example, and your CEO will go to different states on different meetings with big investors organized by your underwriter. Most likely, I've seen one um, in a hotel room or maybe a big conference room or a big so a road show, right? Then you will talk about the business, which industry you are in the business, what's the growth of your business, how does it play with competitors, who are your competitors, what's your vision for the company, and you would say, we need funding for these projects because we can return a company with a high EBITDA of on how many years, which is actually higher or comparable to the market and other stuff that it will be enticing for investors, right? So remember we talk about ROI. Investors would want to hear a high ROI, return of investment company, that they can invest on compared to the current rate. So if the market's running at 15% return on investment, and if your business, the one that you're going through an IPO process and issuing stock, would say that you're estimating 20% and the future is bright, then it means that it will be something that you would want to invest on as an institutional investor. So think about eBay before it became an IPO. So when it's going through an IPO process, hey, we're the e-commerce marketplace alternative to Amazon and whatnot, right? Um, when uh, Lyft or Uber went public, and then everything else in between. So there are companies that they know like these are the buzzword of the tech industry, and then now they're going in with say EV or any technology that you're looking at, even AI. So, for example, ChatGPT is from OpenAI. Open OpenAI is actually a platform, right, by Sam. And then right now it's not for profit. I think that's the reason why the board left some of the board because they want to take it public. And then taking it public would mean that they would actually get more funding. And then making more funding would mean that they will be able to fuel research, R&D, and everything else. So they would actually go through a roadshow. So that's the main discussion point. Now, I'll go you to the capital market, right? So the capital market, once you issue it, the stocks, that's what you call the primary market. So the first issuance of the stock on the capital market is the primary market. You can go through the New York Stock Exchange or the Nasdaq. Now, why are they two? So the national exchange is the New York Stock Exchange. And then, so when you see CNBC, when you watch the news, and then you see people trading like um, Wall Street type, right? Trading on the floor, as they say. So the trading on the floor is basically New York Stock Exchange, right? That's the New York Stock Exchange. The Nasdaq, these are like a large cap, billions of dollars, high equity companies market or in the equity. The Nasdaq is a different type of stock exchange or exchange. I would say exchange. Why? Because you don't see a trading floor. It's all electronic. So everything is electronic, and then that's how they actually do their business, right? So there are no people trading, making the signs to buy or sell. It's basically end of day trading that they actually, not during the day, end of day trading that they actually have electronically using algorithm or whatnot. That's the NASDAQ. So capital market is when you want to issue either, you want to get capital financing either through debt or equity. We're talking about equity first by issuing stocks. We mentioned about an IPO process, initial public offering, the company from private to public. And then once they do that, they would actually go through the first issuance of the stock through an IPO is the primary market, right? So basically, once you issue the stock, you will get the money as a company. Now, if you and I, for example, retail investors bought a stock of the company, so for example, the IPO is for OpenAI, just in case, hypothetically, that they would go to an IPO process. So I have a stock of ChatGPT, as they say. Now, if I have that, if we trade it again, I sell it, I buy more shares after the first issuance on the primary market, it's now called a secondary market. So if I buy a lot, like 100 shares, then I sell five, I keep some. The five that I sold, it's no longer the first issuance, right? Because it went through me and then it went through outside. So it will be on a secondary market. So remember that the stock fell, and whatnot. Think about it this way. Me as the company who got the initial public offering, who got, say, $100 per share of, say, OpenAI, primary market, first issuance, then me, OpenAI, will get $100 per share. If I bought that one share and I sold it for, say, 125, that 125, me as OpenAI, I don't get that number anymore because I got the first issuance of $100. So it's now the retail investor who will get the difference of $25, right, per share. And then that's the secondary market. So those who are trading secondary market is actually um, me as the company who issued the stock doesn't get anything after that one because it's secondary market trading. So let's open up a question. Why would I? So if I don't get it, me as the company who issued the first stock, I only get 100, and then now it's trading at 125, 150 or whatnot. If I'm not getting it, so what's my motivation, right? So the motivation for me, like for remember when Meta or Facebook, when the stock goes down, Mark Zuckerberg is actually concerned. Why? Why would he be concerned if they only get the first issuance as proceeds on the primary market? It's because sometimes how they do deals like Meta or any other business, they would say, "Let me acquire you one more company." I forgot the name of the company uh, that they purchased that they were able to do augmented reality, right? Sorry, I forgot the name. So they bought one company through an M&A, merger and acquisition. When they bought that company, they would say, I'll buy your company for, you can create a deal like this. I'll buy your company for, say, $50 million. And then $25 million worth of stocks of Meta. And then that $25 million worth of Meta is based on the current market value or an agreed upon price based on current. So whatever trending, right? So that's actually why companies are still interested, even though their stocks are circulated on the secondary market. It's because the secondary market side, being bought by retail investors, they craft dealings using their own stock as as a price or as a form of payment. So that's one thing. So I just want to make sure that actually made it clear. And then at the same time, have you heard one of those TikTok wherein they would say, "Oh, I'm from Silicon Valley. I make $200,000." So when I saw that, I'm like, "Okay, what? That's a lot of money." Well, $300,000. So when you think about it, when they get their offer package, it's not only the money that they receive as cash. They also get company stocks valued at. There you go. So stocks valued at, and then people who are VP, director, or whatnot, or part of management would get on their compensation a stock allocation as part of their compensation price. That's why they are invested to do well in the business or to perform in their chosen field or department on their business because they are invested on it because they have they have an interest to it. Okay, so that's actually how we talk about uh, the capital market, right? And then what happens with the primary market and the secondary market. Now, capital market can be stocks or bonds, and then um, we talk about equity through an IPO. We have the money market, quick quick one. This one's long term. We talk about a primary and then market, which will be the New York Stock Exchange, the Nasdaq. But you know, when you think about it, after your stock has been issued through your underwriter that helped you do the roadshow, do the compliance with the SEC, do the arrangement of distribution of shares and everything else in between. The secondary market, the trading platform that they use, can still also be the New York Stock Exchange, or it can be the Nasdaq. Nasdaq is mostly for tech companies, if I have not mentioned it. And then other than tech companies, it was mostly traded using the New York Stock Exchange on the floor. Okay, so tech companies is mostly Nasdaq side. And then the Nasdaq and the New York Stock Exchange can also be trading as a secondary market. So once you issue, then your stock goes around. It can also be on the New York Stock Exchange. Now, there are also what you call regional exchanges. So national exchange is the New York Stock Exchange. A regional exchange is, say, the Boston Stock Exchange, Chicago Stock Exchange. So there are regional ones. Why? Because there are companies who does not want to trade on the national level because they're regionalized. Mostly their business is within the region, but they need funds coming from equity And of course, as an investor, I want to make sure that my risk are actually tapered or mitigated or reduced, right? So I would want to make sure if I'm an investor and I'm putting $10 million worth for a company that I believe. So I rely on the US Securities and Exchange Commission that regulates all securities through the Securities Exchange Act, Securities Act, and the Securities Amendment Act. There are different types of um, exchanges that or the different types of big regulation with securities. That's why the US market is really somewhere. It's like, I don't want to say, oh, well, maybe I can say it as a gold standard. As a gold standard when it comes to managing market or funds or flow of funds. So even big companies like or countries like China, Japan would always go and invest in the US exchanges because they believe on the system. And then the Nasdaq, for example, is actually selling the same platform that they use with the algorithm and whatnot, because we have the proper process mechanics, laws, and whatnot. Now, so national exchange, regional exchange, and then why the difference? Because the regional exchanges, when you think about it, is cheaper to list compared to the national exchange, more regulatory, more not, and then more fees, right? Compliance-wise and requirements. Um, and then those are all just basically getting funds. And then one of the things on the capital market, on the equity side, is actually the two types of equity stocks. So we talk about a common stock before, and we talk about a preferred stock. So let's make sure that we make a distinction if it's not clear yet, right? Preferred stocks are the ones that are given preferred dividends. Preferred dividends is basically that before you declare dividends as a company, the preferred stock is the preferred stock holders are the first one to get it compared to the common stockholders. So it's not as popular in the US. Why? Because me as a company that issues dividends, um, and then it's a preferred stock dividends, it's not tax deductible or it's not deductible for tax purposes compared to me as a company issuing debt instrument to you, and then I would pay you also, of course, as the holder, interest. Interest expense is deductible compared to me issuing stocks as a source of funding through preferred stock. So it's not as popular. And then that's why if you want equity compared to debt instruments issuance wise, people will go with common stock. So common stock, you may or may not declare dividends, but at least you are a holder of a stock of a company as an investor. Now you would ask, so why do you have two? Now, aside from um, equity, so what's the difference between debt financing and then equity financing? On the point of view of the investee, you are the investor, for example, you're investing in my company. I can actually deduct if I issue debt financing. Basically you buy from me bonds as an investment for you. I can do it tax deductible. But when I declare dividends, even for common stock, just in case I'm gracious, I gave you dividends on common stock, you would not have um, you would not have any I would not have any tax deductibility. But why would I want to do common stock compared to investment if it's tax deductibility when you think about it, right? So me as a company would want equity financing because I don't have an obligation to you to pay you every time. I would only pay you if I believe I have excess retained earnings, which is accumulated income, right? So that's the reason why. So depending on the matter, that you look at your investment or your project or your company's growth, you would say the best way is to do debt instrument issuance through bonds or equity financing. So um, when you do debt or issuance of bonds, you normally don't see it being traded like equity stocks but it's actually popular in the US, right? But those are being done through dealers, a secondary market, a primary market to buy bonds of companies. So in Guam, the Power Authority, which is a local government or a government, autonomous government agency, and then the Water Authority, so the Guam Water Authority, the Guam Power Authority, they would issue bonds on the market, and then institutional investors would actually buy it on a certain price. So we do that one also in Guam. That's an example of that one. Now, before going to the PowerPoint itself, I just wanted to make sure that I have a list on my mind right now of things that I need to actually make sure to talk to you, right? So let me just make sure I have it. Um, Now what we've learned is that just as a preview for the discussion today, financial market, I'm just going to do a recap, consists of two types, right? A capital market and a money market. Capital market is the discussion that we have right now, is actually on long term, either equity or debt financing. And then money market is actually short term. It's basically IOU, certificate of deposit, T-bills. As a source of financing, you would actually issue TCD, or you would issue IOUs to institution or a dealer, and then that's the guarantee that you will get. They will give you funds, and then you would need to pay them in return. So that's your form of, but short term, maybe like 270 days or whatnot, less than a year. But if you want something bigger as an amount, a larger cap, then you go through the capital markets route. So I'll stop there, and then we'll go through a second video, which is actually we're gonna go through the actual PowerPoint, and we're gonna go through the theories for today also. Want to give you that background before we go in and jump into detailed stuff. Okay, thank you everyone.